As we move forward through our financial statements, we're now at the point where we added a cart, right? We bought our candy cart. Now we have a capital asset or property, plant, and equipment. And this is a fixed asset that we're going to depreciate over time. So there are going to be two effects that we see on the balance sheet here. On the statement of cash flows. The first effect on the statement of cash flows is that we now have depreciation. Depreciation is a non-cash charge that reduces our net income, and as a result, we need to add it back into the statement of cash flows. So here, what we can do is we can simply link to our depreciation on our income statement. Notice that our income before was $2,000. Well, our income now is $1,600 because it was reduced by $400 of depreciation. But our net income on the cash flow statement really combines those two. We're still making $2,000 of cash from our net income. It's reflected in the two separate lines, net income and then depreciation. So depreciation, I said that every item on the statement of cash flows ties to a change on the balance sheet. That's also true for depreciation. Because if we look over here, we actually see accumulated depreciation, right? It's the contra asset to gross PP&E has increased, or rather decreased by $400. Since that is also on the asset side of the balance sheet, we could model this as minus end of period minus beginning of period, at which point we get that same 400. So it doesn't matter whether we pull it from the income statement or our change in accumulated depreciation. Either way, it's reflecting that change on the balance sheet. Now, the other change that comes with capital expenditures and PP&E is this CapEx line, capital expenditures. Right? This is going to record any investment opportunity, investment activities that we're engaged in. So it's cash flows from investing. So in this case, to reflect CapEx, we simply reflect the change in our gross PP&E over time. So we can take end of period minus beginning of period gross PP&E. In this case, it's 0 because we actually bought the machine at time 0, so it doesn't show up at our time 1 statement of cash flows. To finish up this statement of cash flows, we set our cash flows from investing equal to our CapEx, which are both 0. Let's reinitiate our beginning period cash. In this case, it was very big and negative. And our change in cash now is our cash flow from operations plus our cash flow from investing. We add those lines together. And now we see an ending cash value of negative $200, which, while negative, still matches what we're showing on the balance sheet. So the statement of cash flows is verifying that the balance sheet is correct. Now, once we've accounted for our CapEx, we want to account for the loan that we used to actually pay for that CapEx. So in this case, we've already accounted for our depreciation. We've already added our CapEx. Now we're going to add another section of the statement of cash flows. This is the last major section, is cash flows from financing activity. So in this case, our financing activity is we went out and raised capital, in this case through debt. So we have our long-term debt to add in here. So again, we're looking at period 1. We raised the debt in period 0 in our example. So for change in long-term debt, we simply take the end of period debt minus the beginning of period debt, and we see that there was no change in long-term debt in this case. We can again set cash flows from financing equal to that total. Other times you're going to have more items that go into this. For example, if you raise equity, that would also belong there. But for now, we're just doing a simple equals here. Finally, our change in cash is going to add everything up. And we see that our ending cash, again, matches our balance sheet statement, but balance sheet cash. One other change that you'll notice happened here is our net income went down. All right, our net income is now $1,475. Well, if we want to recall what happened there, we now have an interest expense, right? Because we added that debt on, it affects our income statement. The income statement is affected through the net income that then reflects through to the retained earnings, right? So it's still a balance sheet effect. We saw that the interest expense reduced our net income. It reduces on our statement of cash flows, which is also reflected in the change in retained earnings. So again, it all links back to changes in the balance sheet are reflected in the statement of cash flows.